So what I want to look at now is learning objective number 2. Learning objective 2 looks at the 4 major circumstances in which adjusting journal entries are necessary. Now, the reason why we need these adjusting entries is that even though there are transactions occurring that are related to expenses being incurred and revenues being earned to the business, we don't automatically record them when they occur. So for example, if you're operating a business and you have employees, you don't record journal entries at the end of each day that they work. You may record an entry when you pay them. And what do you do at the end of the month when you owe them salary or wages, but you have yet to pay them? You need to bring the financial statements up to date. And that's why we need adjusting entries. We need entries that recognize that there are activities occurring, there are resources that are being used, there are revenues that are being earned, but they are not explicitly related to a transaction triggering event occurring that will lead us to write it down in our general journal during the period. So what we do when we reach the very end of the financial period and everything's completed for the financial period, we record a series of adjustments to bring everything up to date, to make sure that we record all the revenues that have been earned for the period and all the expenses and the associated changes in assets and liabilities. So what I want to do now is I want to show you the circumstances in which we require adjusting journal entries. Okay, so there's a bit of information here in terms of where adjusting entries relate to the accounting cycle. And as I mentioned in the previous learning objective, I said that you record your accounting transactions throughout the period, you consolidate them into the T accounts, and we extract something called an unadjusted trial balance. So that is, there's no adjusting entries that are related to the accounts in that trial balance. After you've done that, then you record the adjusting entries that we look at today. So let me take you through the 4 different types of adjusting entries. The first set of adjusting entries that I'm going to discuss relates to when a company receives cash before it provides the service, or when a company earns revenue before it receives the cash. So let's start with the company that is receiving cash before it provides the service. This is referred to as deferred revenue, right? Deferred meaning that we receive cash up front, but we defer the revenue recognition to a later period of time. And Qantas is a perfect example of a business that does that. They take your money when you book the airfare typically, or at least before you get on that airfare, and they deliver the service at some point in the future. Okay, so what you can see here is a similar announcement that I showed you last week in the workshop. They're talking about flight credits extended. So if you booked a flight that now has most likely been cancelled, at least if it's in the next few months, then of course Qantas owes you that service and the amount that you've paid, and is recognizing that here in terms of the validity of that payment for future credit for flights that you can take. Now, I also noticed this part says flight credits must be requested by the 30th of April. I don't remember seeing that last week, but anyway, if you booked a flight with Qantas, you probably want to look into that very soon. So if we go back to our slides, when a company receives cash before it provides a service, we refer to that as a deferred revenue. That's one type of adjusting entry. The next one we have here, when a company earns a revenue before it receives the cash, it is an accrued revenue. So that basically means what we want to do is, even though we have not received the cash from the customer, we want to bring the revenue forward and recognize it now, because we basically did what we needed to do to meet the obligations and expectations of the customer. And a good example of that typically is, say, a carpenter. So carpenters will typically do work for customers and then expect payment at a later point, right? This is accrued revenue. They acknowledge that they've earned the money when they have done the work, but they charge you later. Well, I suppose they charge you later depending on the degree to which they trust you. So if they don't trust that you're going to pay up when they send the invoice, then they may ask for cash up front. And in that case, then this reverts to a deferred revenue where they've received cash up front and then they deliver the service afterwards and earn the revenue afterwards. So they defer the revenue to that point. Okay, now if we look at classifying adjusting entries further, we look at the remaining two. The remaining two I want to talk about relate to expenses. So when a company pays for a resource before it uses or consumes, that company has a deferred expense. So my iPhone prepaid account is an example of this. I have paid for the resource up front, but I use it later and therefore I defer the expense recognition to the time in which I use up that prepaid account, and so therefore I record the expense associated with that time I use it up. Sometimes companies often incur expenses and pay them later. Now, a classic example of that, as I showed you earlier in this workshop, is your electricity bill. Typically, energy providers charge you post-usage. So you use the electricity. Obviously, here I have my bill. They show me all the electricity that I've used. That, incidentally, is related to my hot water service. So my hot water service over the quarter used 803 kilowatts hours of electricity. Lucky it's on the controlled load that only cost me 10.6 cents per kilowatt hour. They report and send me this invoice post usage and then I pay. So accordingly, if we go back to our slides, this for the organization recording this particular event, the company incurred the expense in terms of electricity and pays it later. So that's an accrued expense. Obviously, we want to recognize the fact that we have incurred an expense, but we will pay for it in cash later on.